Welcome to the deep dive. We're your shortcut to getting up to speed, and today, well, we're tackling using multi-factor models. Super important stuff for CFA Level 2 candidates, and honestly, just very practical for anyone in investments.
Absolutely. Think of it like this. The standard capital asset pricing model, CAPM, it gives you one view, right? Market risk. Multi-factor models, though, they're like getting a whole set of different lenses.
Different lenses, how so?
Well, they help break down why an asset behaves the way it does. Is it sensitive to inflation surprises, changes in GDP growth, company size? It gives you much more explanatory power and, frankly, more flexibility when you're building and managing portfolios.
Okay, let's unpack that. We often hear about arbitrage pricing theory, APT, as being sort of the foundation here. What's the core idea behind APT?
Right, APT. So at its heart, it suggests that an asset's expected return is basically a linear combination of its sensitivities
Yeah,
to various systematic risk factors plus the risk-free rate.
linear combination.
Okay, yeah. And the key assumptions are, one, that asset returns do follow a factor structure like this. Two, that specific risk, the stuff unique to one company, well, that can be diversified away. And three, the really crucial one, in an efficient market, there are no arbitrage opportunities.
No arbitrage. That sounds critical. Can you walk us through what exactly an arbitrage opportunity is and maybe how we'd spot one using this APT framework?
Sure. So an arbitrage opportunity is essentially a zero-risk, zero-investment strategy that still generates a positive expected return. Think free money, risk-free.
The classic free lunch, which isn't supposed to exist.
Exactly. You'd spot one if, say, you could build a portfolio of assets, maybe A and C, that perfectly replicates the factor exposures of another asset, let's call it D.
Okay, same risks.
Same factor risks, yes. But crucially, asset D offers a different expected return. If D's expected return is higher than your replicating portfolio, boom, that's your arbitrage. You buy the undervalued D and short the relatively overvalued A and C combo.
Got it. And you calculate that expected return using the asset's factor sensitivities, how much it moves with each factor times the risk premium for each factor.
Precisely. Sensitivity times the price of risk for that factor summed up, plus the risk-free rate. That's your APT implied expected return.
Okay, so APT gives us the theory. How does this play out in the real world? What kinds of multi-factor models do people actually build and use?
Great question. There are, broadly speaking, three main families of models. First up, you have macroeconomic factor models.
Like inflation, interest rates, that kind of thing.
Exactly. But specifically, it's the surprises that matter, the difference between what actually happened and what was expected. Unexpected inflation, unexpected GDP growth, those are the factors. And interestingly, the intercept term in these models, that represents the expected return based on current information.
Okay, surprises in the big picture. What's next?
Second, we have fundamental factor models. These use attributes of the companies or stocks themselves as factors.
Like company size or value metrics like book-to-market ratio, maybe leverage.
You got it. Things you can observe directly from financial statements or market data. Now, a key difference in how they're built. With fundamental models, you usually start with the attributes. The sensitivities are known, like the PE ratio, and then you estimate the return associated with that factor.
Right, whereas macro models identify the factor's surprise first, then estimate the sensitivity.
Exactly. It's a subtle but important architectural difference. Fundamental models often give you a really granular view of risk, breaking it down by industry, style, country, etc.
Makes sense. And the third type?
The third are statistical factor models. These are derived purely from the data itself, from historical asset returns. Techniques like factor analysis or principal component analysis are used.
So just letting the numbers speak.
Pretty much. The advantage is minimal economic assumptions. The downside, well, it can be really hard to interpret what these statistically derived factors actually mean in economic terms. They might just be mathematical constructs.
Right, and that interpretability you mentioned for fundamental models, that seems really valuable, especially for digging into portfolio performance and risk.
Absolutely, and that brings us to a really key application: understanding and managing active risk. For CFA candidates listening, you'll know this as tracking error.
Tracking error, yeah. The volatility of my portfolio's returns relative to its benchmark.
Exactly. Multi-factor models let us decompose that active risk. We can see how much comes from deliberate bets on factors like overweighting value stocks, that's active factor risk, versus how much comes from picking specific stocks within those factors, which is active specific risk, or security selection skill.
So you can tell if a manager's outperformance came from, say, just riding a wave of value stocks doing well, or if they genuinely picked the best value stocks, like using the Carhart four-factor model, perhaps.
Precisely. It helps separate luck from skill, or at least factor timing skill from stock selection skill.
Uh-huh.
And then you have the information ratio, which is your active return divided by that active risk. It tells you how much return you're getting per unit of that active risk you took.
Okay, so better risk attribution, better manager evaluation.
And fundamentally, it helps you as an investor think more clearly. These models provide a richer picture than just market beta from CAPM. They help you figure out, well, what kinds of systematic risks do I have a comparative advantage in bearing?
Comparative advantage.
How so?
Well, think about someone whose salary is very stable versus someone whose job is heavily tied to the business cycle. The person with the stable income might be better positioned to take on more business cycle risk in their portfolio, potentially earning that risk premium because their human capital isn't exposed to the same risk.
Ah, I see. So you can tailor your portfolio tilts based on your own unique circumstances and risk tolerances beyond just a simple market exposure. That's the idea. It allows for much more nuanced, potentially more efficient portfolio construction by considering these multiple dimensions of risk.
Wow, this deep dive really highlights how powerful these multi-factor models are, much more than just CAPM. It's about getting a really detailed map of the risk and return landscape.
Indeed. Understanding these different dimensions lets you make, hopefully, much more informed decisions. You move beyond just the market factor and start tailoring your strategy. Which really leaves one big question for you listening.
Which is,
What risk dimensions do you think you have a comparative advantage in bearing? Something to really mull over for your own investment approach.